Hi, everyone. This is Jason Bierek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's an author. He wrote How to Invest in Gold and Silver, a complete guide with a focus on mining stocks. His name's Don Durrett, and he also runs the website Gold Silver Data. Thank you for joining us again, Don.
Thanks for having me back, Jason.
Now, Don, gold's been an outperformer in 2016 so far. There's been some occasional pullbacks, but it looks like the dips are being bought. Why do you think the fundamentals for gold appear to be better? And why do you think more managed money, these billionaires on Wall Street, the Davos crowd, why do you think these guys like Ray Dalio and others are starting to move back into gold?
Well, it all has to do with economics. Last year, in the third and the fourth quarter, you started to see a slowing down of growth in the U.S. And the year before, in 2014, 2015, you had 3% growth basically in the U.S., 2 to 3%. And third and fourth quarter last year, it was slowing down much below that. And so people are starting to recognize that the debt situation around the world is starting to become serious. And you're starting to see people start to get what I call the fear trade, start to go into gold as a hedge, and then it basically takes on a life of its own. And then you start to see an uptrend. And that's what we've been seeing here in the first quarter of this year. We're seeing an uptrend in gold. It's just kind of a reversal of the downtrend we've had over the last 5 years.
Yeah, this negative interest rate policy talk, I think it's also doing it. And besides gold, a lot of people are going into just all cash. People are selling out of their stocks and bonds, conventional assets and things like that. So, some people, they can't decide, with the volatility, what's going to happen in the markets and volatility and what the central banks and politicians are going to do. So I guess, people holding cash, people holding gold, that seems like a good insurance place.
Yeah, going back to the fundamentals, once we got to the end of the fourth quarter, it was starting to become pretty obvious that we had a lot of headwinds in the economy. Especially when you look at exports. Exports have really turned negative for China and Japan. We're starting to see double-digit year-on-year decreases in exports. And we haven't seen a pickup economically anywhere in the world other than the U.S. And so if the engine of the U.S. starts to slow down, then potentially you could have liquidity problems. And I think that's what people are starting to notice. A lot of people are saying, this is going to be a big crash this year because of the debt situation. We have very, very high debt. And if we don't have a strong enough economy to service that debt, then conceivably you could have liquidity issues, and you could have a recession in the U.S. And that's driving a lot of people to take a look at gold.
To add to your point there, Don, too, a strong dollar also causes debt problems too, especially with the developing countries, which when the dollar was weak, they borrowed in dollars. Now their currencies, especially Brazil and many others, they have enormous amounts of debt, and they were borrowed in U.S. dollar terms, and in their own currency against the dollar has fallen a lot. It's fallen just in the last 12 months by more than 30%, in the last 2 or 3 years by more than 60% against the dollar. So you've had just enormous collapses basically in commodity currencies and developing market currencies, and this just adds more to the debt problems there. And then you have the politicians in Japan, the central bankers in Japan, in Europe, and now Federal Reserve Board members talking about negative interest rates. That's going to put even more pressure on people who are already in debt.
Yeah, you're exactly right. And to go to your point about negative interest rates, Japan went to negative interest rates in February last month. And so that added to the trend of gold going up. Now, just yesterday, the ECB, one of the portions, they basically announced a new QE program. And part of that QE program was some negative interest rates on one portion of some held deposits. So you're starting to see a trend towards negative interest rates. And investors think that these negative interest rates are actually going to be positive. For instance, today the Dow is up almost 200 points, and we're back up to 17,000. The S&P's back over 2,000. We've had basically a fairly strong run this month in March after we saw the negative interest rates, after we saw the low QE in Europe yesterday. So the stock markets seem to be strong. That gives me a little pause, a little concern as a gold and mining investor, gold and silver mining investor, because if the stock markets are strong, then investors think that there's some underlying strength there. And the one thing that's kind of the kryptonite for mining investors is strong economies, because if you have strong economies, then you don't need strong gold prices. If you need strong gold prices, the miners aren't going to do any good. So a lot of people are very, very bullish right now on gold. They think that, the sky's the limit. It's going to take off here. But we definitely have some headwinds. And, the stock market, if it's going to keep going up, that's not really, it's showing some underlying strength. I'm not sure if the underlying strength is there or not. The PMI numbers have been pretty negative. That's just the Purchasing Manager Index, both for manufacturing and for services. They're basically almost in stall speed. They're very close to recessionary numbers. And I mentioned the exports again coming out of Asia have been very, very weak, negative. So I'm not sure, where gold's going right now. We have basically 5 lines in the sand we have to cross to get a breakout here. The first is 1280, and gold's tried to break through 1280 this week a couple times, and it just couldn't do it. Every time it went up to 1280, it just got hammered back. But it goes down to 1250 where it's at right now, and then it's going to make another run at 1280. And then once it gets through 1280, it has to go through 1308, which was the last high it has to go over. And then the next 3 numbers that I'm looking at is 1350, 1400, and 1450. So all 5 of those need to get taken out before I basically say we can say that the reversal is in. We're going to start heading higher, and miners are going to do extremely well. But right now, we're still in the risk. We still have risk. There's still a possibility this thing could break down. So we're not out of the woods yet. Once we get through 1280, things are going to be looking better than 1308 and better. But we still have to cross a few resistance lines here.
Back to something you mentioned a couple of minutes ago, you talked about the stock market starting to go up again. I don't think it's going up again on fundamentals. I don't see any evidence really that the U.S. economy is continuing to improve. Most of the jobs that are created are part-time jobs. If they are, the labor participation rate still, at multi-decade lows. And, there's just been so many job cuts in the key states that had almost all the job growth of the high-paying full-time jobs since 2008. And those were the oil and natural gas states in North Dakota, in Texas, and Oklahoma. Those states have had massive job losses for over a year now. So I don't see any evidence that, yes, the U.S. consumer is going to get some type of savings with cheaper gasoline. It may put a little bit more money back in their pocket, but their bills are still going up day to day. Their property taxes, Obamacare health tax, things like that. A lot of people are still struggling to find a good full-time job. Most people are putting together, a couple part-time jobs, even in the DC metro area. So I don't see evidence then that there's justification for the stock market recovery. Maybe it's the threat then of more money being printed with QE4, or maybe there's money coming in from other countries then. Maybe there's more money leaving China, or there's more money leaving other developing countries and heading into the United States market, kind of like what happened then prior to the October 1929 crash in the United States, how, the U.S. was the last economy booming. There was an enormous money and credit expansion by the Federal Reserve during the 20s. And then, as other countries were already in enormous depressions, lots of money and capital came to the United States. Do you see that kind of playing out that way right now?
Well, the point I was going to make is about the strength of the economy. So yes, you are right. There really aren't any signs of strength. There aren't, for instance, for the stock market to be rising as strong as it has the beginning of March. Right. Where is it coming from? Where is the growth coming from? Housing, we still have a little bit of an uptrend in housing as far as the prices go, not in sales. Sales have been fairly flat to negative, but there's some bit of an uptrend there. Healthcare is still fairly strong. There really isn't any sectors that are strong enough to support, this stock market going to 18, 19,000. Other than inflation, oil was up to New York oil 38 today. Brent was 40. So oil's been up fairly strong in March. That's been helping the stock market. People think maybe there's inflation there. But again, back to, if you're a gold and silver mining investor, the one thing that you want to see is you want to see this economy weaken, because that's going to really, we want gold to break out. We want gold to break out strongly. We'd like to see gold, like I said, I want to see it get over 14, close over 1450 this year. That's a really important number. And for that to happen, we're going to have to see, I think, the stock market roll over. I just don't see the stock market staying up here at 17,000 or higher, and we get to 1450 gold. Something's going to have to give on one way or the other. Right now, it's looking like that the stock market and the economy probably are going to roll over based on the numbers, and that gold probably is going to break out. It could happen really quickly. I mean, next week the stock market could go down 500 points, and the trend could be down. It's hard to say which way it's going to go. I'm just saying right now we're kind of in no man's land. We're not sure which way it's going to go. The trend seems to be negative for the economy, but we're not quite there yet. The numbers aren't completely compelling. I think you could argue both ways.
Yeah, I think the manipulators, the central banks, the plunge protection team, the exchange stabilization fund, whoever else is behind the scenes, they can move the stock market one way or another, and individual markets. They can't fully stop the trend, but they can slow things down or create a temporary reversal. But when I look at the gold stocks, Don, and I'm looking at a year-to-date chart for the Sprott Gold Miners ETF, which is SGDM. That's up like about 45% year-to-date. I mean, normally the conventional definition of a bull market, right, is when stocks in an industry are up 20%, right, in a year. So we're way over 20%. We've had a very nice rally here, and you're saying you're not fully convinced then that gold is back in a bear market? Back in a bull market.
Oh no, I'm not convinced. The HUI is actually up 74% off the bottoms of 6 weeks ago. So the HUI was at 99. Today's at 174. So up 74% in 6 weeks. So I should be excited. I'm up 74%. Is that a bull market? Is a 20% market a bull market? I would say no, even until it's really been confirmed, and we really aren't going to get confirmation until we close over 1308. Remember, these markets are very, very volatile. You could lose it all very, very quickly if gold, if it can't hold 1200 or 1220. I would say if we stay over 1220, then we're going to go higher. But if 1200 doesn't hold, we could go back into 1150 fairly quickly. These things can really turn. Now, if we are in a bull market, 1220 will hold, and the 1308 will get taken out. So the question, if you're investing in these mining stocks, is what's going to come next, 1150 or 1350? Right now, it looks like 1350 is going to come next, and if that does happen, then we're definitely going to be looking at a bull market. Now, for me, what I'm looking for is a new high in gold. So the old high was 1935. So we're down here, today at 1250. We're $700 away from where I want to get to. So I'm looking at kind of that's the price point I'm after, a $700 gain. So are we in a bull market? So I'm not going to really get excited until we close over 1350. So down here at 1250, I'm not excited yet, being even up 75%. You have to remember, most of the miners have been beaten up. The HUI was down 80%, and the HUI is the majors. So the juniors are down 90%. So a 75% gain. I mean, if you're a mining investor, you're still pretty beat up.
Yep.
We need to break out a lot higher than this before we can really break out the champagne.
Yeah, I would definitely agree with that. The dollar, the U.S. dollar, gold and silver bull market, I think it's restarted, but you've obviously made an argument that it may not have restarted. But one thing I will say, though, is that the gold and silver bull markets in other currencies, it's very clear. Gold and silver are near almost all-time highs in almost every other currency except for the U.S. dollar. And, when we look at miners, gold and silver miners operationally, when we look at their operating costs and things like that and their profit margins, the last year or so, with cheap oil, with a declining currency, so a cheap Brazilian real, a cheap Mexican peso, a cheap Australian dollar, these miners, their margins are really good as long as they're not mining gold and silver in the United States.
Well, that's true. It depends on the company, of course. I would say that the majority of the silver miners are probably still struggling at 1550 silver. they're still struggling. Majority, you only have about 30 silver producers anyway, but still, I mean, we're not in a bull market for silver miners by any means, even though a lot of these stocks have doubled in value, but they doubled off their lows. But I think that as a mining investor right now, you have to be very optimistic that this could be our year where we break out. Things are looking, they're looking very good. We're just, like I said, I want to see the stock market roll over. If you look at the stock chart for instance, the S&P 500 or the Dow since 2000, we had, if the charts it's pretty amazing. Basically you had this trend, this uptrend, and then you have a crash, and the crash happened right around 9/11, the first one, and it was a severe crash. It was over 45%. Then you had an uptrend all the way to 2007, and then we had our 2007-2008 crash, and it was more than 45%. And now we've had an uptrend from 2009 all the way up to 2016, and it looks like it's starting to roll over. And if that does roll over, we're going to see a really big breakout in gold. So that's what I'm looking for. That rolling over of the S&P and the Dow, that hasn't happened yet. We got really close, and now it's back up to 17,000. So will it roll over? A lot of people are expecting it to roll over. If you read Zero Hedge, there's article after article, or people think it's going to roll over and it's going to crash. But when is it going to roll over? Is it going to roll over this month in March, or is it going to take the rest of the year? I'm not sure. But right now, as a mining investor, I think that's what you have to look at. You have to pay attention to the stock market and see if that rolls over. Because if it doesn't, stock market stays strong. The more that it stays strong, the more that a lot of these miners are going to, there's going to be headwinds there, if you will.
Now, we had a PDAC recently, the Prospectors and Development Conference in Toronto, where a lot of the royalty and streaming companies go, and the mining companies, the producing miners and the juniors all go there, and deals get done. We saw some pretty decent sized deals in the last week or two, whether that was Silver Standard making a bid for the Canadian gold miner Claude Resources, or Endeavour Mining, which was an African gold miner, make a bid for True Gold, which is an emerging gold producer with high grades and low costs. Right. Their Karma mine's about to come online. We've also seen, I think, Tahoe Resources, which is a Guatemalan silver producer, make a bid for Lakeshore Gold. Do you expect more mergers and acquisitions to come because capital is starting to come back, but miners still can't get enough of it? Do you expect to see more mergers and acquisitions out of necessity then in the near future?
Oh, yeah, absolutely. And the reason why is because it's so easy for these companies to get away with lowball offers and get accepted. All of the deals that you mentioned, they're all at basically 40% premiums, and 40% premiums off of we're coming off a low here in the mining cycle. So these stock companies are not overvalued. If you look at Lakeshore Gold, for instance, that's a very, very strong company, and it's selling at a discount because we're in the bottom of the cycle here. If you value these companies at higher gold prices, they're worth a lot more money than they're getting bought for. So right now, I think you are going to see some more deals, of course, and then hopefully, the companies will start rising in value. The hard part, for investors, if you will, is if you find an undervalued company, for instance, True Gold, and you invest in it before they build the mine, you get in early, if you will, and you price out the company what you think it's going to be valued out based on their cash flow and based on future prices. And then they build a mine, and as soon as they get it into production, somebody goes and buys it for a 40% premium. It's kind of disheartening as an investor, and it happens over and over again. And so if you're buying companies and you have the cash, you can grow fairly quickly, and you can buy these companies for great valuation. So you're going to see more and more deals, of course. And this is something that we have to deal with as mining investors. The other side of the coin, you want to be the company that buys these companies out because you're getting adding some, we call it accretive value, and
it's a buyer's market. Yeah,
it just adds a lot of accretive value to these companies where they just can explode in value. You watch what happens to the cash flow of these companies. And the only buyout that I didn't like was Silver Standard. They bought Cloud Resources. Cloud Resources doesn't have a lot of resources. If you look at how many million ounces in the ground they have, I would have thought that, but they were a low cost producer. So, Silver Standard, they just wanted the cash flow. They wanted the low risk. It's basically low risk positive cash flow. So, but as far as from a shareholder standpoint, I mean, how much value does it add? I thought it would add a lot more value if they bought a company like Brazil Resources, who has 3 large projects, and they're valued, I think, under $50 million. Deals like that. I don't know why somebody doesn't go and buy Brazil Resources. I mean, it's unbelievable how strong their projects are, and how undervalued they are. So gold in the ground right now, if you don't have a path to production, is unbelievably cheap still. So you're going to see a lot of deals.
Brazil Resources, without going into too much detail, since our consulting clients, pay me to look through the financials and things like that, their share structure since the company was created has exploded. I think the share structure has increased fourfold, and I think they're nowhere near even feasibility study level on their mines. So they have a long ways to go to get that mine into cash flow. A lot of these mining executives, when they do acquisitions now, Don, they're looking for, how quickly can the mine get into production and cash flow? Is it feasibility level? Can I buy, resource for cheap, but also cash flow? So like I said, it's a buyer's market, so they're greedy. So they want the ability to buy cash flow for cheap and also resource for cheap.
Right.
And Brazil Resources offers neither of those things. Plus, I said there's things there with the CEO compensation. If you look how much the CEO, I know KC Research loves the CEO there, but the CEO is getting paid way too much money. Let's just say.
Now, all right. Now, I didn't say I liked Brazil Resources. I said I liked their properties. So Brazil Resources has 3 really good projects. I'm just saying, if you want to buy them out and then develop their projects, you're going to be buying gold in the ground for unbelievably cheap. So they had their own 2 million ounce project, which is 1+ gram per ton open pit, and then they bought Brazil Gold, which had another 2 million ounce, 1 gram per ton open pit. So there's 2. That's 4 million ounces there. Then they bought Kistler's Whistler project. Kiska Metals, Whistler project, which is another really nice project. So they have 3 really nice projects. Yes, they all have to be developed. I'm just saying you can just buy gold in the ground for really cheap. It's going to take time to develop them, but Silver Standard, they have the team to do things like that. There's 3 projects, just develop them one after another.
Yeah, I prefer, we've talked about this in the past. 2 weeks ago when we actually recorded the first version of this interview and then Skype screwed it up, we talked a lot about royalty and streaming companies. The royalty and streaming companies, the funny thing is they actually preferred when metals prices were lower. In the last couple of years, they invested collectively over $4 billion in deals in the last 2 or 3 years. So that's Silver Wheaton, Franco-Nevada, Royal Gold, Sandstorm Gold, and the new one, Osisko Gold Royalty. So they've been putting a lot of money to work at low metals prices, but a lot of that money, though, went into already producing miners with bad balance sheets, and so they bought streams from them to help out the miners with bad balance sheets. But I think, now with metals prices higher, the miners can go back to the market now, and this is what's going to worry me and why maybe the bull market may, in mining stocks may take a little bit of a break. We're starting to see these miners, who have bad balance sheets start to go back to the market as quickly as they can and sell as much shares as possible to buy themselves time just because they've mismanaged their company for so long.
Yeah, this is where it gets really, really difficult to be a gold and silver mining investor. It just takes a lot of years of experience to learn where the where the red flags are. There are just so many data points you have to understand, and one of them is dilution. Absolutely, they have the ability and they have the right, if they want to issue shares anytime they want, as long as the public will buy those shares. And if you own the company or you own shares in the company, there's nothing you can do. You just get diluted. It happens time and time again. That's one of the downfalls. So. It's one of the areas, but I'll talk a little bit about streaming companies. So yeah, streaming companies, royalty companies, they're kind of like in a win-win situation. They win, if prices go up because they get more cash flow. because they, for instance, the silver, a lot of the silver contracts, they're paying $4 and they're selling their silver at the market price. So if it goes higher, they're going to get more cash flow. And then if prices stay low, then the mining sector is under pressure because they have trouble raising money, raising capital. And so these streaming companies, they can make fantastic deals. So they win. It doesn't matter which way it goes. They're going to win. So it's kind of a win-win. The only thing as an investor, the negatives on streaming royalty companies, and the reason why I don't personally invest in them, is the upside. It's really hard to value these companies. You just don't know what kind of returns you're going to get. I prefer to focus on companies that are producing or developing projects, so I can value them based on future cash flow, based on future gold prices. But I have a hard time valuing the streamers, the royalty companies. And I usually value them like as a three-bagger, long term. I don't value them usually higher than that. But I do think that as a dividend stock, a lot of these companies could do fairly well, fairly good income stocks. So they're going to be fairly strong companies.
Yeah, the only way royalty and streaming companies can really fail is if the management team gets too greedy, takes on way too much debt to do deals, or they have they put way too much money into one big deal and the deal goes bad, or they do a couple deals in a row that go bad and the stock price goes down, then they can't do more deals. So as long as that doesn't happen, the royalty and streaming companies, they can diversify a lot more than a lot of these smaller miners, because, the one thing that worries me with a lot of these smaller miners is they may have one good project, maybe two good projects, but they basically have to go all in and bet the whole company on developing the one mine. And if there's, a delay in either cash flow, either getting into positive cash flow or generating free cash flow at their mine, or the costs are higher at the mine than expected, or the government, the country that they operate in, changes the tax laws, or there's probably a dozen different things that could go wrong at the mine operationally that I'm sure you could talk about. But it's very frustrating, if you put a lot of money into one of these mining companies, smaller ones, and yes, the numbers on paper look great. I've discussed this with hedge fund managers and other mining stock newsletter writers like you. The costs look low at this mine, everything looks good, and then all of a sudden, 6 months or a year later, things didn't go as planned and the company's bankrupt.
Right. Yeah.
So how do you think then our listeners, how should they mitigate that risk, and how do they protect themselves with diversifying to avoid, something like that happening?
Well, the first thing they should do is read my book. So I have a book. It's How to Invest in Gold and Silver, a complete guide with a focus on mining stocks. And it's basically a textbook. It's a thick book, 300 pages. It's the only book out there that teaches how to invest in junior mining stocks. So you read that, it'll show you all the red flags, all the things you need to look for. The other thing one of the things I say in the book, the best way to kind of avoid these things is to use small investments on each of your companies. For instance, I say never to go over 2% of your investment portfolio on a single stock. And that 2% should only be on literally the best of the best. And you shouldn't do very many at 2%. Most of your investments, I think, should be right around 1% of your portfolio. So I own a lot of stocks, but if one stock goes bad, it doesn't hurt me. And any stock that has really big returns, and in a lot of these miners, they have really big returns, you should go all the way down to 0.5% of your portfolio. So you're looking at 0.5%, 1%, and then 2% is the most on a single mining company. So if you're going to do a streaming stock, I would only do 2%. That's how you kind of avoid a lot of risk. It's when people go and put 5%, and some people put 50% of their portfolio into a single stock. And to me, that's just way too risky. I've put 3% before, and it's just too much risk. So
When the gold and silver miners were roaring, Don, in 2010 and part of 2011, I knew a couple people who had almost 100% of all their net worth in a few handful of juniors. So, and they were going up for a while, and then a lot of them ended up at zero.
Yeah.
So, I mean, like I told them, like stop losses. You could have bought puts on junior mining ETFs. There's things you could have done to hedge out your portfolio to protect yourself on the downside with some insurance. None of the people I'm talking about didn't do any of this. But from a risk reward perspective, Don, what are some of the gold and silver mining stocks you like right now, despite the big run up, that our listeners should add to their watch list, maybe on dips?
Well, I have an article on Seeking Alpha that has my favorite 20 stocks. So you can just go to Seeking Alpha and search by my name, Don Durrett, and it has a list of the 20 best risk reward stocks. And so they can just do that. But to tell you a little bit about risk reward, that's why I got into this, and that's why I wrote in my book. To me, mining stocks is all. Why should you even get involved in mining stocks if you're not going after a big reward? Except for maybe, for instance, in the streamers. I mean, those are the risk is a little lower on those. But most of your individual miners, other than the majors, of course, have very high risk, or you're going to go after a high reward. So for me, I'm looking for, most of my stocks, I'm looking for a 500% return, except for the majors, of course. I use the majors mainly as kind of foundational stocks and as income stocks. But after take the majors aside, I'm looking for 500% return stocks. So on my website, it actually shows you the future valuation of the company based on a future gold price. And you can stick in whatever gold price you want to use as a future gold price. I use $2,500 gold and $100 silver to value my companies, my stocks. And so I'm looking for a 500% return. And then I start looking at, okay, here is the reward, here's the upside. This is your potential future cash flow, your potential, what I use is a future market cap growth rate. And I look for a future market cap growth rate over 500%. So that's the reward. Then I start looking at all of the potential red flags. And the red flags, I mean, they're so numerous, and so you have to hunt them all down. The first one, of course, is not the first one. There's dozens, actually. I look at the balance sheet, for instance. If a company has debt before they get into production, that's a red flag. You really don't want that, because then the company can go bankrupt. You want a company that's, if it's developing a mine, that they don't have any debt, and then when they do finance that mine, that's enough cash to get them into production. And then it has the rate of returns. You want to make sure that the stock has enough rate of return. You don't really want to invest in marginally economic projects. So you want to get an after-tax return. I like to be over 25%. So it's basically that's where your risk is reduced, because it has a high return. And if a company has a high return, it usually has the all-in cost is usually under $1,000, for instance. You're looking for that. So you don't expect the price of gold to go under 1,000. It probably won't. So if these companies have all-in cost, anywhere, 8, 9, even 1,000, the risk is reduced. And then the other thing you look at, of course, is the location. You don't want to be investing in a lot of bad locations. I don't have a lot of investments, for instance, in Africa. I think I own 3 or 4 stocks. So you don't want to group them all, in really high risk locations. And then there's other aspects you look at. You look at the grade, of course. You don't want to, because the lower the grade, the higher, generally the higher the cost is going to be. And then if it has a lot of base metals, I don't like to invest in companies that are really highly dependent on base metals, because that could turn on you. It's something, if it's a long-term investment. And then, of course, the management team. You want to make sure that you're comfortable with the management team, that they can pull it off. And the guidance from the management team, for me, is a real risk indicator. If a company doesn't have a good website and they're giving you a lot of really solid guidance, I can usually tell, after been doing this for 10 plus years, looking at the guidance that a company's doing, that they're actually going to build the mine. The companies that are, for instance, Red Eagle Mining, I could tell the first time I analyzed that stock, that management team was going to build their mine. They had it all planned out. They were telling you in advance exactly what they were going to do. I mean, once they had the PEA out, they were already telling you the timeline until production. So the company, you can really start, that can de-risk some of these projects. You just get a feeling for them. The companies, they tell you exactly what they're going to do, and then they execute well. But there's lots of gotchas that you have to do for the risk reward, and that's how you invest. You try to find the best companies that have really good rewards, and then you can minimize the risk based on all the factors that you're looking at.
Yeah, the gold mining industry, Don, is very difficult from an investment standpoint. Even if there's a good project, a management team could still screw things up with the financings, or the management team could pay themselves way too much money. They could steal stock options and things like that and drastically dilute the shares. They can destroy the balance sheet with too much debt. They can do bad acquisitions of bad projects and then have to write them off and things like that. So there's a lot of pitfalls there to investing in the industry, which is another reason why I like the gold and silver streamers, because they can grow with free cash flow and be diversified, and a lot of times they don't have to grow with any debt. But yeah, there's more upside. I also own mining stocks. I own First Majestic Silver, which is run by one of the best CEOs in the industry, Keith Neumeyer. But, one of the other CEOs in the industry, Rob McEwen, who's a billionaire, he's been talking about how bad streaming is for the industry. But, how many of these companies are run by billionaires like Rob McEwen, who participate in every single financing? And, if his mining company, McEwen Mining, or some of the other investments he has, if any of those companies need extra capital, he'll either buy more shares or he'll give them a personal loan at a low interest rate. I mean, there's in the real...
Right.
Yeah, I mean, in the real world, like almost no other companies besides Rob McEwen's companies or Keith Neumeyer's companies or Ross Beatty's or one or two other billionaires, all the other companies don't have billionaires backing them, so they have to go where they can get capital, and that's either they have to sell shares, they have to either take on debt, which is, the risk, taking on debt's the riskiest, because then that means almost immediate bankruptcy, or they have to sell a royalty or a stream on their mine.
Or cash flow, of course. So let's talk a little bit about, so cash flow to me is just the whole key to the mining industry. Cash flow is what generates revenue, generates the market cap, generates the share price. And the other thing, this also goes to the de-risking part. So you talked about First Majestic, Keith Neumeyer. So yeah, I got into First Majestic early. I still own it, and I like it. So the key is that these companies, the first mine that they build, that they basically are successful, and that mine creates the cash flow for the company to grow. And that's what Neumeyer did. I mean, he built his first mine, and he used that first mine, to grow the company. And now he's up to, I think, 16 million ounces silver equivalent, and he's still going. I mean, so the internal cash flow, they really don't even have to go to the market and raise equity financing if they have enough cash flow to grow their company. McEwen Mining is another one. This downturn, I took advantage of it. I bought McEwen Mining at 99 cents. I couldn't believe it went under $1 because the management team. I mean, I think that Rob McEwen is one of the best in the business, and he owns a significant amount of McEwen Mining, so he has skin in the game. And plus, he built Goldcorp, so he knows how to build a company. He knows how to grow a company. So he's going to use cash flow to build a company. So that's one of the ways you can look as an investor to kind of de-risk. Some of these companies, yeah, you have to buy them. I bought First Majestic in 2009, February 2009, after the crash in 2008. You have to buy these companies at the bottom on these dips, and then you get in early, and then you just ride them for years and let the companies grow, because it takes a lot of years for these companies to develop new mines, develop new projects, and grow. So somebody builds a mine, they build that first mine, and they're successful at it. And sometimes you kind of get a feeling before they build that first mine that they're going to be successful. The management team, Argonaut was one. They built their first mine. They did a great job, and now they're off to the races. I'm hoping Red Eagle does the same thing. So some of these companies, they build their first mine, and it's off to the races. They buy a second mine, they buy a third mine, and they can start growing. And so the most risk is buying a company that doesn't have any cash flow. They're going to build their first mine. Are they going to be successful at it? Are they going to be allowed to do it? Because a lot of these companies, they get taken out. Like True Gold got taken out. Lakeshore just got taken out. St. Andrews Goldfields got taken out. All three of those companies had the potential to grow into really big companies, and now they won't get that opportunity. So they get taken out. Sometimes is the best thing to do is to buy these companies that are going to grow on their own. They're not going to get taken out, and the risk gets reduced because you have a good management team and they have good projects. The only risk that you're really looking at is the price of gold and silver. If it goes low, your stock's going to go down. As long as the price of gold and silver goes up, these companies are going to do really well. I'm talking about the companies that have good management teams and good projects.
And that's, I think good advice for starting to do research in the sector. A lot of research is required for these stocks. You know, it's not one of these Warren Buffett free cash flow like stocks like Johnson & Johnson or Coca-Cola or something that has easily predictable cash flows and, you know, customer bases and things like that. It's not like that in the mining industry. The royalty and streamers, their cash flows are a little bit more predictable, although, you know, they do rise and fall with gold and silver. They just, you know, their costs are more controlled, whereas a miner has a cost curve. A lot of the royalty and streamers have a cost line because their costs are more fixed. But I just want to thank you again for your time today, Don. If our listeners want to get your book, how did they do so? And please tell listeners more about gold, silver data.
Will do, and thanks for letting me do that. So Amazon is probably the best place to get the book. You can either get it in digital form or you can order it. Now, as far as my website, so we were talking about doing the due diligence, if you will. So on my website, there's over 550 gold and silver mining companies in it. And you can search it by cash cost. You can search it by market cap. You can even search it by risk. You can search it by location. So the database is incredibly flexible to search. So if you want to go in there, it's really good for doing due diligence. It has lots of links to different places, you know, their website, how to send them an email to ask the question. So I actually created the website because there wasn't anything out there when I was investing for data. So come and be a member if you're going to invest in these miners, or even if you want to have fun and, you know, just some of these penny stocks. If you want to start out with, you know, $500 and see if you can build it up to 10,000. Stuff like that. But there's a lot of opportunity. If we are going to go into a bull market right now and we are going to run up to $2,000, these miners can do incredibly well.
Okay, great. Well, thanks again for your time today, Don, and hopefully we'll have you back on in the near future, and gold and silver and the miners and the royalty and streamers will all be a lot higher.
All right, very good, Jason. Thanks for having me.